let's go to the custom spread tool, folks. I'm sorry. I'll make sure you're seeing the right screen here. Okay. So JPM, you had the May 1st, 7 days away, 95 puts. Okay. Now, what I might do in this case, Eileen, is I might treat these as two separate positions because you sold 5 of these. You don't have short stock. You just have the short put position. So you sold 5 of these at 3 at the 95 strike. Okay, so we know what that looks like. The stock's right around 90 right now. And the reason why I'm saying is treat this as two different positions is, instead of trying to lump them together naturally, is your 390 puts right now are looking okay. Not great, but they're looking okay. This one is currently in a different situation. So as we talked last week regarding the bull put credit spreads, and Sam offers his thoughts, is that the market has been kind of neutral over the last 2 weeks or so, and his bull put credit spreads have been doing well in that time. And he's been going to full credit is what he mentioned. But if you're worried about a downturn and you're already here, naturally this isn't a structure that we want. So you're already in the money. Now, 2 things you want to check first. They already had earnings, didn't they? I'm sorry. I just want to make sure. Let's go to stock research there. I believe it was one of the first ones, wasn't it? Yeah, so on April 14th, they already had their earnings a little bit, and they've been moving back up since that. Good. I moved up big today, actually. I was at $91 there. Now, this one is the trickier one because you only have 7 days left, and if you haven't managed it, you would ask me that maybe you wanted to do something before the market closed. I'm not sure if you did. I don't think you did because you're still here, and we're talking about this. So what are some of the ways to manage or protect a naked put? Well, you could buy 390 puts in this case, but that would be really expensive. Convert this to a bull put credit spread in the opposite way that you did. If you are concerned, perhaps, about a decline, and I don't know if you'd expect it in the next 7 days or so, but you could also buy maybe 100 strike puts if they're not too pricey, and actually convert this to a bear put debit spread. But I have a strong feeling that the debit is going to be too high. But let's take a look. You did collect $3 for these puts here. So if you're concerned about next week, and naturally you're going to wait to see what happens on Monday, but if right now I went to that May 1st cycle, Eileen, worried about a downturn, and that's not going to work. And that's not going to work, okay? So as you can see right now, the prices are too high. From the premium you originally got at 3, the prices here are too high because if I paid $970 or $960 for these puts, that's still going to give me a debit of $6.60. So the bear put debit would be a locked-in loss. And that's because we're too close to expiration in that case. Excuse me, folks. Okay, so converting it to the bear put debit in this case won't work. I'm not going to suggest going into a ratio spread either as a repair because that does get complicated. So what are your choices on this one now that's deep in the money with only 7 days to go? One, of course, is do nothing. Wait to see if the stock continues this movement upwards because, the signing of the stimulus, I'm sure, had to do something with that last movement towards the end of the day, the new stimulus that came through. That was signed by the president, of course. So one is do nothing, wait to see how this plays out. But right now you're looking at, that $5, $4.90 to buy to close this put, which is really only a loss of $1.90 per contract. Not too bad. Or if you're bullish long-term on JPM and you have the capital, Eileen, you could just take assignment. Well, first off, do nothing. Number 2, just buy to close it. Don't worry about managing it. Take the loss and move on. It's a loss of $190. From what I saw, it's about 5 points, $4.90 to buy it back. You keep the $3. So this structure here would only be a loss of $190. So buy to close. 3, you could roll the put down, take the loss. That would be buying to close again for $4.90, taking the loss of $190, and then maybe roll down to the May 30th, say 85 put further out of the money, and maybe collect another $2 or $3 to cover that loss. So you could roll the put down, as we would with a covered call. 4, If you were bullish long-term, and I know you're not, you're worried about a decline, so we're just going to ignore that, but that would be take assignment, maybe convert it to a covered call or a collar position to help with the loss. So number 4 here, of course, we could take assignment. This 5th one here is take assignment, take the stock. There we go. All right, now, number 5, try to convert it to the bear put debit. We just saw that wouldn't work. Now, if the stock gaps up on Monday, for whatever reason, more effect from the new stimulus that was signed, if you see the stock go up to 92 or 93, you may be able to buy the 97.5 or the 100 for lower cost that would make this a bear put debit. But then you only have 4 days to go with a stock that's moving up. I don't know if you'd want to be in this position, as it's looking like your put, your initial naked put, would be at less of a loss. Okay. Number 6, of course, is trying to do a complex repair by using a ratio spread. Now, if you add a ratio spread, a ratio put back spread to your original naked put position, Eileen, what are you creating? You're kind of creating a butterfly. So you'd have to see if that sort of matches your goals, because the butterfly, a ratio repair on top of your existing naked put, or even a broken wing, might give you 2 ways to lose, although you'd get a little bit of bump potentially here on the premium. But since you already have one short put, you'd be doing a ratio that would be buying 2 and selling 1. Okay, you don't want to sell 2, and buy 1, because then you'd have what? You'd have 2 puts that are naked, your initial and one of these others, with a spread. So you still have a high margin requirement. A ratio repair here would probably consist of buying 2 and selling 1. What you'd end up doing is creating a bear put debit spread with a bull put credit spread, a sort of butterfly position that might put this peak back up above profitability. But it'd be very small because you only have 7 days left. Let's take a look at one of those. Here we are here with our original position is the short 90 put. Now, what I might do is probably look to sell, another 95 put. Yes, it's in the money. And then I'd probably buy, let's just keep it a 2.5 point, buy a 97.50, buy a 92.50. So we're going to sell another 95 at 505, midpoint roughly. Yeah, no. Yeah, we'll call it, no, 510. We'll call it 510, okay? So now that, this would be 10, I'm sorry, twice as many. So you're going to have 10 total sold. You already had the one at $3. We're going to do the other one at $4.10. So what is that going to give us? Well, that's going to give us an average cost basis of about $3.55 for these 10 strike puts. Okay? I'll just do it that way. We'll average it. So you're going to average a premium of $3.55, and you're going to buy these 2. So essentially you're going to have one bear put debit spread and one bull put credit spread, buying 2 at different strikes and selling 1. That's going to be sort of the repair. Does it give you a profit? Now, did I do that wrong? Oh, I did. I'm sorry. That's what we want. Oh, no, it doesn't get us to profitability, unfortunately. And I doubt we would do it with the hundreds. And the problem is because we're too close to expiration. So this in-the-money put here, both the in-the-money 95 and the in-the-money 97.5 or the in-the-money 100 are too close to intrinsic to give you any time value, which would give you that benefit there for that type of repair. Okay? So wait to see what happens Monday. See if we get another pop, of course. Then we'll start considering about the repairs. And with those other ones, the 90 strike puts that you have, yeah, the time's too short, Sam. That's when you run into with these kind of positions. With the 90 strike puts that you have for the 15th, right now we're okay. And if you see a move tomorrow, again, I'm sorry, Eileen, on Monday, you might be able to buy it back more cheaply because you're worried about the downturn. And again, just being in the straight put positions, that's probably not what you want if that is your concern. If that is your expectation that there might, in the next 20 to 30 days, there might be another drop as well, okay? And, Sam says the sectors which are strong in stocks related to the virus, and of course gold, you're in gold stocks right now as well, and INO, okay, and you would mention Apple and Amazon. Bank stocks are weak. Yeah, there's going to be some weakness, potentially more weakness, I should say, Sam, in the bank stocks. I agree with that. That might be the concern here. Okay, other stocks Sam mentions are Apple, Amazon, BYND, Beyond Meats, and Microsoft. Ernie's in a Microsoft position. He is in a Abbott Labs position. I'm in the Kraft position as opening others. That Beyond Meat one looked pretty good as well. Okay, so that's that. All right, I mean, so one more thing very quickly as I scroll through here. Okay, you don't have any stock positions. Okay, so right now just consider this. What you have, don't consider it a ratio spread. You have two naked puts, one for the first expiration in May 1st expiration on Friday, next Friday, and one for May 15th, standard expiration. Later on this weekend, go to powerup.com/webinars.asp. Send that, as always, to the chat. I'll send that to everyone in the chat window there. All right. Fantastic. And go to the Options Strategies tab. And scroll down here, and I think it's from 2017. There it is. Oh, it's older than that, 2015. Managing your naked put position. So this is going to give you ideas for adjustments for the naked put positions to help maximize gains or minimize losses. Whether the naked put performed as you wanted, dropped just below your short strike price or dropped significantly. When we talk about various ways here to turn a potentially loser into a winner or maximize the profits on a winning trade. But there's topics there that we'll go through and discuss management techniques here as the stock has fallen in price and beyond, okay? Let's see, when you have only one, oh, Sam says when you have only 1 week left in your options, time stop is about 2.5 days. It's kind of hard to maintain the position as it starts to move against you. Yeah, so it's been in the position for a while, but with only a few days left to go, that time starts to work against you very quickly if you're needing to repair.